Minister Lee, how did the talk go with Greer?
Good talks.
What topics did you discuss?
Topics on trade?
Are you going to talk with him tomorrow?
Probably not.
When's the next talk with Greer?
I don't know yet.
Will President Trump and Xi have a meeting?
I don't have any information.
How about a phone call?
I don't have any information.
The Chinese Vice Commerce Minister telling us that he had what he called good talks with the U.S. Trade Representative in South Korea. But can the two sides hammer out a lasting truce in 90 days? Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the trade and tariff headlines with crucial context and sharp analysis. A Bloomberg survey of analysts and investors see the U.S. maintaining the 30% tariffs on China after the 90-day truce that's expected to erase 70% of Chinese exports to the U.S. and heap more economic pain. The U.S. may not be immune to the fallout. JPMorgan CEO Jamie Dimon tells us he's not going to take the chance of a recession off the table as the erratic trade policy heaps volatility on markets. Meanwhile, the friendship between Prime Minister Modi and Trump is not helping India much. As the countries kick off trade talks this weekend, Trump had this warning for the Apple CEO.
I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India.
We have a great lineup of guests on the U.S.-India trade talks representing the Indian pharma industry. Nandini Piramal, the chairperson of Piramal Pharma. And after that, we'll be talking with the India head for Australia's Macquarie Group. While Asian equities and U.S. futures Welcome to Insight. Asian equities and U.S. futures trading cautiously following a week-long rally in global stocks. Let's check in with Avril Hong on what's getting investors to tread more carefully towards the end of the week. And Avril, it's no longer about FOMO, it's about JOMO, the joy of missing out.
Yeah, I mean, it's a very different dynamic compared to what we saw at the start of the week, right? Markets were exuberant because of that U.S.-China trade truce, so optimistic. And then at the start of the week also, that economic resilience, those signs of that coming out of the U.S. But end of the week, I think investors are turning more cautious. You look at the U.S. economic picture based on the data, but also maybe investors turning a bit more realistic when it comes to the trade talks. It could be a long, drawn-out, protracted process. So that may be prompting the caution to return to the markets. Futures are pretty much flat for the U.S. We are seeing it trading sideways when it comes to Asia stocks, but it's not just about what we're getting on the U.S.-China trade truce or when it comes to U.S. data. Keep in mind as well, it's also about these Chinese tech earnings. We did not get the hat trick, right? When it comes to JD, Tencent, things were looking really solid, and then Alibaba disappointed. Keep in mind, this is also a stock that Michael Burry is buying put options on for the first quarter of this year, but some have pointed out that maybe this is more to hedge long positions. Still, that reflects some form of uncertainty when it comes to not just Nvidia, but also Chinese tech names. Now flip the board, because as I said, it's really about the US data. And indeed, what caught the market's attention, by the way, they're pricing in still that 2 cuts from the Fed this year. It was the PPI, right? Producer prices out of the US, which reflected maybe companies are taking that hit from tariffs because it fell unexpectedly by the most in, I think, about 5 years. And then when you look at the retail sales number, it also decelerated. And the control group component, that was also softer than expected. So cause for concern if you're looking at these treasuries. The rally overnight extended today. And don't forget that overnight we also saw a 9 basis point move on the 2-year, Has.
Well, It is how much conviction investors have. They've been changing their mind on how many rate cuts there will be for the year. Avril Hong, thank you so much for that. Now, as higher tariffs dim the outlook on the U.S. economy, a Bloomberg survey suggests markets should brace for more economic pain ahead for China as well. According to analysts and investors we polled, U.S. levies imposed on Chinese products will likely hold at 30% through late 2025. While that's much lower than the number before the truce, Bloomberg Economics says the current rate is still high enough to wipe out 70% of Chinese shipments to the U.S. in the medium term. JPMorgan CEO Jamie Dimon tells Bloomberg exclusively he's not too optimistic that 90 days are enough to hammer out a trade deal that will please both sides, but he's happy that at least they are talking.
I think it's the right thing to do is to back off of some of that stuff, to have an engaging conversation. I'm grateful they did the U.S.-UK deal. It's an agreement in principle, so, there's a lot of uncertainty still, and there's a lot of uncertainty still in the China thing, but at least we started. It obviously calms down the markets.
And Dimon also told us that he's not taking recession off the table for the U.S. as the fallout from Trump's trade war continues.
We have all this uncertainty. Some preceded the new administration, like we had large deficits, interest rates going up, inflation going up, and some are, tariffs and things. And of course, the geopolitical situation is very tense, very difficult, and hard to resolve.
Okay, so if you forget projections, numbers, what's your hunch? Is the U.S. going to go into recession or not?
Look, I'm going to defer to economists who give it about a 50% chance. I think all these things are probably inflationary, a little bit more, and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
If you look at the trade war and then the somewhat reconciliation between the U.S. and China, does it hold?
I think it's the right thing to do is to back off of some of that stuff, to have an engaging conversation. I'm grateful they did the U.S.-UK deal. It's an agreement in principle, so, there's a lot of uncertainty still, and there's a lot of uncertainty still in the China thing, but at least we started. It obviously calms down the markets. That's not the reason to do it, but the markets, do vote and something like that, and so you'll still have uncertainty to resolve. There's 90-day triggers in a lot of these things, and hopefully they will be resolved. But they're complex. I don't expect immediate resolution, to the satisfaction of everybody in 90 days.
But do you expect markets to settle from here because we have a little bit more of a blueprint, or could volatility pick back up at any second?
Markets are quite unpredictable. I think there's a lot of uncertainty out there that you can't discount. War in Ukraine, terror in the Middle East, Iran, huge deficits, our tax bill, which I would like to see a good tax bill pass, the tariffs, the reaction of countries to tariffs. The EU and the UK are about to negotiate, and I think they have a chance to actually develop a great relationship, partially making up for, the disaster that Brexit became. And so, yeah, those are uncertainties. You can't eliminate them because you want to.
But what are your biggest clients saying about this market volatility? Have they made money on the back of it?
Yeah, some do and some don't, and volatility could be good or bad depending on who's facing it. So, but I would expect continued volatility. I think it's a mistake to think we can go through all the things we're going through and the volatility itself will calm down.
Has it been good for JPMorgan? What's your trading revenue looking like?
Yes, because when there's volatility, this is a very simplistic way to look at it. Spreads gap out and traders make more money if there's more volume. So we had both this time, more volatility, more volume. But very often when you have a lot of volatility and spreads gap out, there's much less volume. So you've seen examples where there's good volatility and there's bad volatility. This one happened to be good. The next go-around may not be so good.
And that was JPMorgan CEO Jamie Dimon speaking to Bloomberg's Francine Lacroix at JPMorgan's annual Global Markets Conference in Paris. Now, let's get insights with our guest, who is responsible for ING's wholesale banking activities, which contributes about a third of the bank's total income. Joining me exclusively, Andrew Bester, head of wholesale bank at ING. Andrew, good to have you with us.
Great to be here. Thank you.
When you hear Jamie Dimon speak, he's like a voice of caution, almost voice of reason, coming at a time when the S&P is close to record highs. How are you assessing market sentiment, reasonable or not?
Look, I think even we've just been hearing from Jamie Dimon, I think very much the way I think about it as well. I think there is uncertainty that is creating quite big gyrations in markets and big shifts in sentiment. But I think some of the underlying issues at play need to be resolved, whether it's the China trade negotiations. As he says, it's good that sentiment has been cooled down and we need to work through the 90 days. 90 days is a very short time to renegotiate a trade deal. But I think if one can get the parameters and frameworks in a better place, but I still think one needs to be relatively cautious navigating this, because markets are moving around. Certainly what we see with our clients is being very active in making sure that they cover the risks they have. So on the corporate side, look into your supply chains, making sure you're hedging, whether it's your commodity inputs, your foreign exchange inputs, but also in interest rates, locking in where you can, because what these markets do is create windows where certainly for CFOs, as we talk to them, say, actually let me lock in some of these inputs so I can navigate the uncertainty better.
So you're saying there's too much optimism then, right? If you take a look where levels are right now, they seem pretty too upbeat.
Look, I think the equity markets are, as you say, at very high levels, and we've seen that gyrate through this year. I think that, but what's happening a bit in some of these markets is there isn't very high volume in some of the markets. So I think we still need to look at it through a fairly balanced view, and certainly as a banker, trying to weigh up the risks and making sure that we are both advising our clients through this. But as Jamie Dimon says, what companies need is certainty, and certainly at the moment, the uncertainty means that investment decisions are being deferred. So what you don't have is an environment where people are making some of those very big strategic decisions they need to make. Having said that, the overall sentiment is sound. The banking system's in good shape. There's access to finance. But that uncertainty does mean that people are slightly more cautious.
You talked about how your clients are hedging, right? Because there's so much risk out there. How are they hedging?
So I think what you're seeing is effectively, certainly for interest rates, people looking and using some of the sentiment in the yield curve to start looking longer term out, and those curves have moved around quite a lot recently. So we see long-term interest rate hedging. I think some of the FX inputs, we also see that, and then locking in the commodity side. So what we are seeing is clients looking proactively at the suite of risks they have. And certainly my advice for clients, particularly when you're in environments like this, is don't try and outdo the markets. There are obviously practitioners and funds out there that do this for a living, but mainly for corporate clients, it's what are my inputs? Let me not try and be too clever. Let me lock in some of the inputs into my business so I have more certainty, so that I can make sure I can continue to deliver for my clients.
What are the assumptions you are making right now? I mean, when it comes to the U.S. economy, Jamie Dimon has not erased the possibility of a recession, and essentially where the dollar goes from here as well is a big consideration for your positioning.
So certainly our house view would be that not dissimilar to what Jamie Dimon's saying. We do think that there will be a slowdown in growth in GDP growth as we get through the year in the US. I think that certainly our inputs would be there may be recessionary risk, but effectively it could be technical. So for us, what we see is a trend towards flat growth. What we can't fully judge is, does that dip negative, and does that create potentially a technical recession? But again, our view would be we start seeing some muted growth next year, sort of in the circa just over 1% range next year. So there is this near-term uncertainty we saw in Q1, some of the numbers jumping around, particularly around trade, but it's quite hard to read through that. But I do think that I think we could see some softening, but with sentiment picking up both in Europe and the US next year.
So there's been a lot of volatility.
Yep.
Trading business has been profitable for the most part.
Yes.
Talk to us about the kind of potential you see ahead.
So look, I think for us, what we see in our markets business has been very active helping hedge clients, and I think that certainly, again, as I alluded to, the implication for our clients as they hedge is they're looking at how they cover some of those risks. That's been good for our hedging businesses. I think on the financing side, what we've seen is slightly more. We've seen some projects get deferred. I think the good news is people are still looking at what they need to do, but there's certainly been a sort of slowing down in the pace of some of the financing activity we see. But overall, in the markets area, very active. Clients are looking to what they need to do, and certainly when you run a markets business, typically volatility in reasonable bounds is good for one's business, but that's primarily because you're helping your clients cover the activity, and you see very increased levels of client flow as they try and cover their risks.
We know that given the volatility, deals are being hampered. I mean, what's the outlook? Do you see perhaps a recovery, a revival maybe later in the year?
Look, I think for us, I think sort of maybe pick up on Europe because we haven't talked much about Europe. I think certainly for Europe there are some interesting structural changes around the way. We saw the recent changes in some of the financing in Germany. I think that does create an interesting backdrop from a financing point of view, and I think that what that's going to drive is increased infrastructure investment. I think also increased defence spending in Europe. And those are both drivers, given the scale of ING's business Europe, that we do see continued activity. And because Germany is the largest economy in Europe, that should have a spillover effect across the rest of Europe. So I think that creates an interesting structural benefit and something in Europe that's going to play out, and we certainly see that. And that means we do see an acceleration of growth in Germany as we get into next year.
And in terms of consolidation within the industry in Europe, do you see that happening? Do you hope to capitalize on that?
So look, I do think that there's been a lot more activity in the whole banking sector across the Eurozone and in banking. I expect that to continue. Certainly the position that we have at ING as the leading European bank is I think we will seek more consolidation, and given our scale in Europe, we would expect to participate in that. As and when and how that happens, I think we'll need to see.
So in the next 12, 24 months, are you assessing, or how are you looking at it? What are the potential that you might, participate in that consolidation?
Look, I think for us, it's looking at it. I think certainly what I think Europe does need is, more larger banks effectively looking on a more pan-European basis. And certainly one of the implications for Europe is to make sure that we continue to have those pan-European champions. And ING already operating in my business across 23 markets. We have the breadth and scale. But I think I do see opportunities across the various countries in Europe for more consolidation. And I think it's going to be interesting to see things like Capital Markets Union and the like creating a better backdrop for some of that cross-border activity. But we do see ING being a participant in that in the medium term.
Do you see risks to the European economy, for instance, that might hamper the activities that you're anticipating?
Look, I think certainly if I look at it sort of maybe a sort of a bit of a lens into the European consumer continues to be in robust shape. When we look at our retail business, we continue to see people continuing to have, be active in terms of spending, investing. House prices continue to track. So the underlying overall sentiment is relatively good. The business side, again, business sentiment is dealing with some of these uncertainties, but effectively off a fairly robust platform. So I think that there is the makings of continuing. I'm sort of cautiously optimistic, but fairly balanced. I think we need to keep an eye on the risk, but at least some of the fundamentals are there. The other benefit in Europe, which is good, is the banking system is in very good shape. I think after effectively 20 years since the financial crisis, we start to see a strength in the European system from a banking point of view. That is good for the economy. It's good for individuals. It's good for business. So that creates a sound backdrop.
We know that ING is big on sustainable finance. We know that when it comes to defense as well as energy, that's come front and center, right? It's a big priority for Europe right now. How do you see the bank capitalizing on the opportunities there?
So I'll maybe start with sustainable finance. That area continues to be an area where we do see ourselves as being a global leader. Activity has continued there. I think as we think about energy and energy security, certainly for Europe, sustainable energy is going to be a very important ingredient of that for the medium term, alongside other aspects, and we see good activity. As a data point, if we had a 25% increase in what we call volumes mobilized, helping companies work through their transition to a sustainable future. So actually activity has been strong there. I think if we look beyond that, continue to see good levels of activity across the economy. From an infrastructure point of view, our sector expertise at ING grew out of financing complex infrastructure. So for us, all the activity that's happening around the infrastructure investment in Germany and beyond is good for us because we have the sector expertise to be able to support that. So that is good for our business. But I also think crucially, particularly in Germany, will create a stimulus for more growth.
It is an evolving landscape when we talk about sustainable finance, right? I mean, how do you see that playing out?
Look, I think we continue to see the need for alternative sources of energy. So certainly in the whole financing space, we see that. And we see that right across the world. Whether I take my trip in Asia this week, having discussions with clients in Japan, activities in Korea, conversations over dinner last night across what's happening in Southeast Asia. So we see activity right across our business for looking at creating renewable sources of finance, in addition to the broader constellation of energy needs there. But certainly, I think one of the points here is people looking very actively at the energy security, the sustainability of their energy infrastructure. And again, ING is very well placed to help our clients think through that.
Andrew, great insights. Thank you for stopping by.
Thank you very much.
Andrew Basta, head of wholesale bank at ING. Let's do a check on China Tech on the back of the earnings that we saw from Baba, which disappointed, as well as NetEase, which beat estimates. Take a look where Baba is right now. Disappointment playing out in terms of its stocks, down about 5% as we speak. NetEase in the opposite direction, surging 13%. It rose as much as 16% earlier. Tencent, Baidu in negative territory. NetEase's first quarter earnings beating estimates, and that's playing out in its stock price right now. Well, still ahead this hour, our exclusive interview with Piramal Pharma's chairperson, where we discuss how Trump's tariffs could impact the outlook for the pharmaceutical industry and what she expects from the India-US trade talks. Keep it here with us. This is Bloomberg. You're watching Insight. Nissan CEO Ivan Espinosa says the carmaker must get its own house in order before considering partnerships with other companies. Nissan announced it is closing factories and cutting 20,000 jobs in a bid to stem mounting losses as it posted its worst financial results in 25 years. He spoke to Bloomberg about whether these measures were enough.
We're confident that this is enough because the plan, as I said, is robust. It has a leg on the fixed costs, which is what you were talking about, restructuring our manufacturing footprint and work around our overall size in terms of human resource. But not only, it has another very strong leg on the variable cost front. Yeah, on the variable cost front, we also have around 250 billion yen of costs that we will reduce. And we are already working on this. We started a few weeks ago with a team of around 300 experts. And in the few weeks that they started to work, we already have visibility to around 75 billion yen of savings in variable costs. Yeah, and we're accelerating this by putting additional 3,000 dedicated people into this sprint on the variable cost front that will drive a lot of savings. Yeah.
Given the uncertainty and the lack of visibility when it comes to tariffs, of course, how will that impact the overall restructuring effort?
Yeah, well, the manufacturing footprint, the design that we put around is very flexible. So one of the beauties of Nissan is that we are a global company that has a very broad footprint in terms of operations. And taking this into account, the plan that we have laid down has this flexibility to adjust because for the moment is the US, yeah? But the world is moving, you know, by the second. You know? So now we have this problem in the US, but we may encounter, unfortunately, more headwinds in the future. So the manufacturing footprint strategy that we have laid down allows for this flexibility.
Your liabilities will rise to over $5.5 billion by next year. So despite right now where you stand in terms of the capital position of Nissan, you're not necessarily looking at a full-blown merger at this point.
Yeah, we're considering, as I said, the strategy today is to focus on the short-term improvement of a company. Again, the point is not to do a partnership because we need to be partnered with somebody because of a cash position. The cash that we have on hand is enough to go for the next 12, 18 months without doing anything.
Nissan CEO Ivan Espinosa speaking with Bloomberg, the Asia Trade co-anchor Sherry On. And coming up, an exclusive interview with Piramal Pharma after the company announced plans to invest $90 million into expanding facilities in the US despite global trade tensions. Keep it here with us. This is Bloomberg.
this is most likely going to be a series of talks focused on very narrow wins, but certainly touted, at least by the U.S., as a big win.
Trump actually has backed down, so therefore, I believe China has really won this tariff war for the first round.
This postponement gives us a little bit of breathing room, but the simple fact is the world did change in the White House Rose Garden at that 9 p.m. that evening. We're not going to go back to where we were before.
Some of our guests this week sharing their insights on the 90-day tariff truce between the U.S. and China. And staying on trade, President Trump says the Indian government has made an offer to drop all tariffs on U.S. goods. He gave no further details on this while speaking at a business event in Qatar. India's trade minister is expected to meet Trump administration officials in the U.S. this weekend for negotiations. Meanwhile, the president also says he's asking Apple to stop moving its iPhone production to India.
I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India. You can build in India if you want to take care of India. We want you to build here, and they're going to be upping their production in the United States, Apple. So Apple's already in for $500 billion, but they're going to be upping their production.
And pharmaceutical tariffs could be high on the agenda for trade talks between the U.S. and India. Trump earlier this week signed an executive order to cut drug prices in the U.S. by tying them to lower prices paid abroad. But the plan faces legal and operational barriers. Joining us exclusively, Nandini Piramal, chairperson at Pharma. Nandini, good to have you with us. First off,
thank you.
The trade talks between the U.S. and India this weekend, how much is at stake for companies like Piramal?
I think when it comes to the trade talks, we are big believers in the network effect between the U.S. and India. So we would want there to actually be free trade. But when it does come to onshoring, we actually have facilities that can manufacture in the U.S., in Michigan, Kentucky, as well as Pennsylvania. So if people do want to onshore, we do have the capabilities and the capacities in order to do that. And as we said last week, we're going to invest a further $90 million to expand that facilities in Michigan as well as Kentucky.
Are you then saying that you're willing to spend more, invest more in the U.S. if needed? And are there plans to do that?
So I think what we said last week is we're going to invest a further $90 million to expand our facilities in Riverview, Michigan, as well as Lexington, Kentucky. This planned investment will start probably next month and will come online between the next 6 months to 1 year.
When it comes to the U.S. market, how much potential is there for you? What's the outlook like on the back of a spate of directives from the Trump administration?
I think currently people haven't yet made manufacturing decisions because they're waiting for the uncertainty to clear up. But I do expect that there will be more onshoring in the U.S. And when people decide, as I said, we have the capabilities and the capacities in order to help our clients.
You talk about your clients. Are they rethinking their strategy when it comes to supply chains? How are they navigating such an uncertain environment?
I think, honestly, it's a bit too early to say. There's been a lot of news flow over the last few months, so I think people are evaluating and scenario planning.
But on the back of that, how might they diversify? How might it look like? I mean, what comes to mind when you think about diversification?
I would imagine that people would want to onshore some things, especially maybe the final product. But the quality and the cost in places like India are beneficial overall to the world and to the company, because if you don't actually manufacture in a low-cost country like India, you actually would end up with higher prices for U.S. patients and consumers.
Nandini, talk to us about the growth potential for Piramal in the coming 12 to 24 months. Where are the growth drivers? What are the growth drivers?
So we've had a couple of 2 very good years that have been driven by on-patent manufacturing as well as innovation-related work driven by U.S. companies, both in the U.S. and India. I think we could expect to continue that over the next 5 years, and we kind of hold to our doubling of revenue as well as tripling of EBITDA by FY30. So I think we honestly believe that that's the track that we're on, and there might be near-term uncertainty as people try to figure out and do scenario plans. But I think the FY30 guidance is something that we're still standing behind.
Might your numbers be hampered by the delay in investment decisions?
I think that, as I said, there may be some near-term uncertainty, but I do expect that once it settles down, we have a very good network that blends both onshore production in the US and UK, as well as offshore production in India. So I think once it settles down, I think we have a great network to help our clients achieve their aims of helping patients.
How about in terms of the global pharmaceutical industry? Some people are betting on a quick and robust recovery. Do you see that happening?
As I said, I think once there's more certainty, I think I'm a big believer in the power of U.S. pharma innovation, and I do believe that the innovation can help patients change their lives and help ameliorate their health conditions. So I do think eventually innovation will win.
Nandini, talk to us about the GLP-1 drugs. We know that demand is rising. This is a drug that helps counter diabetes as well as obesity. How are you capitalizing on, rising demand for the drugs?
I think at this point, we're only working with customers who would we want, if they want to develop the GLP drugs, we have the capabilities to do so, but we're currently not working on it on our own.
And what kind of demand are you anticipating in the coming 12, 24 months? Could you give us a number, put a number to it?
No, I think that, as I said, we're not necessarily working on it on our own, so I think that would be a hard number for me to give you right now.
Let's turn the attention to the Indian market. I mean, India provides most of the generics. I think it accounts for about 80–90% of the drugs that's consumed in the US, for instance. How do you see the Indian pharmaceutical industry getting impacted by the tariffs and the moves adopted by the US?
I think India provides very high quality as well as low cost ability and kind of drugs to the US. And I would hope that continues, because if you onshore generics, for example, that would actually increase costs for US customers, because research shows that manufacturing in the US is about 5 to 6 times more expensive than in India. So I would hope that we actually have a kind of allied nation kind of concept where friendly nations get together to actually make drugs at scale and in low-cost countries.
Some have suggested perhaps that the tariffs would impact the quality of the drugs produced out of India. Is that a reasonable concern?
I think India produces some very high-quality drugs. We've, I think, got some of the highest number of US FDA inspections. For example, in our own quality network, we've had no FDA, no OAIs and no warning letters from, in our entire history as a company. And I do think our quality systems are actually very, very strong. So I'm not sure of the kind of relation between tariffs and quality.
Nandini, I appreciate the fact that there's so much uncertainty out there. What do you view as the biggest risk for your business?
I would hope the uncertainty resolves in the next 3 to 6 months. But I think the continuation of uncertainty could have challenges, because as people continue to prolong decision making and halt investment decisions.
We heard from Jamie Dimon earlier about how he's not erasing the possibility of a recession in the U.S., where you have investments, of course, and operations. What assumptions are you making about the strength of the U.S. economy?
I would hope that the pharma, again, and innovation still continues to happen and it still continues to be funded. I think the power of innovation and the power of actually making a difference to people's health is something we shouldn't underestimate.
And how about the strength of the Indian economy?
I think so far the Indian economy this year has been doing very, very well, and we would hope that it would continue the focus.
Do you see the growth getting to what it was before, as high as 8%, or what is the sustainable pace of growth for the Indian economy?
I think it's one of those things that I don't want to bet on, because I think I will probably be wrong.
Nandini, just one final question before we go. We know that the US dollar is front and center for companies that have a global presence, global footprint. How is that impacting, your profitability and your costs?
Actually, I think the US dollar has been remarkably steady, at least compared to the Indian rupee, and that's something that we'd like that to continue, and that it helps us plan and to make sure that we kind of can manage amongst the volatility.
Nandini, pleasure to have you on the show. Nandini Piramal, chairperson at Piramal Pharma. Thank you. Still to come, Macquarie Group joins us to talk about the Indian stock surging to their highest level since October on Thursday. More details next. Keep it here with us. This is Bloomberg. Well, this is Insight. Let's do a check on the India Open. India joins the trading day, of course, after surging to their highest level since October on Thursday. Front and center this week would be that India-US trade negotiations. The Sensex currently trading down by 0.2% as India kicks off its trading day pretty much in line with the rest of the region. We have the Indian rupee trading at 85.38. It is up against a USD as we speak. Of course, this is currency that's been weakening, but on the other hand, EM currencies have had a boost on renewed risk appetite after U.S. economic data boosted the case for the Fed to cut rates this year. Of course, markets factoring in 2 rate cuts. Again, India in the negative, the Sensex down about 0.3%. Well, our next guest is maintaining a long-term positive market perspective on India. Joining us exclusively, Abhishek Poddar, India country head at Macquarie Group, one of the largest international investors in India's infrastructure services. Good to have you with us, Abhishek. Why the optimism?
Thank you for having me over, Haslinda. I mean, there are all the reasons to be optimistic. There are very few countries in the world that can truly claim that the next decade would be seeing a 7% consistent real-term growth. We are extremely excited about some of the fundamental tailwinds that the country is seeing, whether it's on the demographics, whether it's on the investments happening on the infrastructure side, whether it's the investments happening in the energy transition, or the burgeoning aspirations of the middle class leading to consumptions on the data and likes of those. All the sectors that we love to play in and all the sectors that we've invested in India over the last 10 to 15 years.
So that's the longer term perspective. How about, the more immediate prospects for the Indian market on the back of the talks over the weekend between the US and India? How optimistic are you?
I think we are in the midst of a realignment of the geopolitical and the macroeconomic trade between various countries, right? We do understand that the broader trend of reshoring is real, and that's what is going to happen. What we also believe is India is pretty strategically placed, both from its geopolitics alignment with global south as well as with the Western markets, to really benefit from this. And what we're seeing is not just the bilateral trades that's happening between India and the US, but the recently concluded BTA between India and UK that's been going on for a while, and that seems to have concluded. EU is interacting with India to have some kind of a free trade agreement. Australia is on the line, right? So there are many of these bilateral trades which are coming into play, which will continue to sort of play beneficially for India. And we've started to see green shoots on the ground as well, whether it's the China 1+1 strategy leading to manufacturing growth in the country. And I must say, I've been covering Indian market for the last 25 years. The amount of optimism and investments I'm seeing in manufacturing, for example, whether it cuts across electronic manufacturing, defense, energy storage, solar modules, and whatnot, is amongst the highest that we've seen over the last 20 to 25 years. So despite the macro, I would say some of the global macro headwinds that we're seeing because of the trade realignment, we think India is quite strategically placed, both because of its strong domestic consumption requirement as well as its multiple bilateral agreements that's going on to benefit from many of these tailwinds. And that's what we have been investing in, and that's what we're most excited about.
As you said, you've been covering the infrastructure sector in a very long time. I'm just wondering how you see India bridging the trade deficit and investments in infrastructure.
Yeah, that's a good point, Haslinda. Just to put out a few stats, right? I mean, India is investing about $150 billion in infrastructure year on year. That's almost 3x the growth that was over the last 10 years, 3.5% of the GDP. And anyone who's been on the ground can very well see that this is a country which is getting built with significant amount of investments happening across roads, airports, ports, railways, you name it, right? And that requires investment, and that requires capital. And that's where I think it's a good combination of public investments that's coming from the government, which has played out in form of, for example, roads. Government has been building in 35 to 40 kilometers of road per day over the last many, many years. But once that infrastructure is built, instead of having the capital stuck in the roads for perpetuity, that's where the role of long-term investors like us come, where the government is able to offload these assets to patient capital like Macquarie's or the various pension funds, and then recycle the capital into future growth itself. And that's a model that has worked very well and continues to bear a lot of promise. We ourselves have invested over $3.5 billion of equity over the last 10 years in the Indian infrastructure space. And much of this has not just returned superior returns for the investors, but also continues to enhance the on-the-ground performance.
Abhishek, even as we talk about India growing its manufacturing, growing its infrastructure, we have headwinds. We have now Trump saying to Apple, you know what, we don't want you to increase your production in India. In fact, we want you to bring production back home. I mean, how do you see this playing out and impact the ambitions of India?
Yeah, Haslinda, we are in the world of heightened volatility. I think that's true. And anything that is purely driven on a particular dependency or on a particular kind of a trade or a country or a segment will always be open to much more volatility. I think what we like of India is it's not a completely export-driven economy, nor does the investments happen only driven by exports, as may be the case with many of the other Asian economies. But we also have a very large domestic base. So just coming to the example of Apple, while we all read the news about Apple sort of shipping off plane loads of AirPods before the tariffs came into existence, what we also see is India is one of the largest and fastest growing market for consumption for Apple as well, right? So whether it's manufacturing happening for exports, there's also a strong domestic consumption driving all of these. So once you cut out the noise, I think some of the fundamentals on the demographics of the consumption as well as the policy reforms that we've seen, continues to make us very positive about the Indian market.
Given that you see India as a long-term play, I'm just wondering if it makes sense for Macquarie to be allocating more to the Indian market, perhaps a rotation from the US to India in a bigger way?
And we're seeing that, Haslinda. I mean, just to give you a sense, over the last 10 years, our primary pool of capital that we've been bringing to Macquarie, bringing to India, was our Asia Infrastructure Fund. That itself has grown quite a bit. The first Asia Infrastructure Fund was about $2.4 billion, and we're already in the fourth vintage of that. But in addition to these, there are a couple of other global funds that we're bringing to India. We have a core renewable fund, which is an open-ended capital, and we have a large portfolio company of the same called Blue Leaf, which is investing into India and benefiting from the significant growth in the renewables that's happening. Similarly, we have an energy transition fund, which is investing in emerging technologies on the energy side itself. And recently, we launched an electric vehicle platform that itself requires $1.5 billion of investment in the coming years as well. So from our perspective, as we take some of these large bets, big ticket investments, few of those platforms across the sectors of interest and where the fundamental sort of value lies, is the way we will look at this. And while we don't have specific allocation for the country, we are very clear that in the coming years, we will have billions of dollars invested in the Indian market.
Which sector are you most bullish about?
I think there are 3 or 4 sectors that aligns well with our strength and which we think there are strong tailwinds. Energy transition is right up there, both across renewables, electric vehicles, and the associated space. Digitalization is another important segment with the significant growth in data consumption, layout of fibers, tower, and associated segments, and transportation, whether it's on the roads side as well as on the ports and the airports front. So these are 3 segments that we are very strong on, and we will continue to bet in the Indian market.
Abhishek, final question, and very quickly in 20 seconds, we know that the market's pricing in 2 rate cuts for the Fed. What do you see the RBI doing in 2025?
I think the RBI seems to be moving in that direction. Our house view is also a similar trend into 25 bips reduction. The RBI has come out very clearly saying they're taking a dovish view. When we speak with the government, with the finance ministry, a lot of fiscal interventions are being also looked at. So we think India will enter, and it's already entered, into a benign interest rate environment, which bodes well for us.
Abhishek, thank you so much for your insights today. Abhishek Potter, India country head at Macquarie Group. Now, before we go, here's a look at our guests next week on Monday. BNP Paribas APAC Deputy Head of Global Markets, Brian McCappin, will be joining us to unpack the outlook for international trade. Tuesday, we'll talk fixed income with Franklin Templeton CIO Sonal Desai. And on Wednesday, we discuss FX with SEB's Head of Asia Strategy. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.